Investment legend Warren Buffett is on the record saying that he thinks diversification is a form of protection against ignorance and makes little sense if you know what you're doing. Peter Lynch goes a step further by calling it diversification and points out that you only need a few good stocks in your lifetime. Japanese investor Akira Katayama is living proof of this. He approaches investing like he once did video games, with complete dedication to the detriment of everything else. In fact, years before he started buying and selling stocks, he had dropped out of school to play the game Ragnarok Online full-time. This went on for a whole 4 years, during which time he became incredibly proficient at the game. This never really translated into monetary compensation, so he eventually had to start thinking of ways to support himself financially. That's when he stumbled upon the world of investing, after watching a 12-episode soap opera about the stock market. Apparently, the types of trades portrayed in the show were totally unrealistic, but the allure of day trading and investing was enough to prompt Katayama to get a part-time job so he could start trading as soon as possible. He started with a bankroll of just under $6,000 in 2005, which he would go on to parlay into a fortune of close to $150 million. As a retail investor who went from rags to riches, he shares a similar trajectory to legendary investor Takashi Kotegawa, but their trading styles couldn't be more dissimilar. Initially a short-term trader like Kotegawa, after a series of ups and downs and a grueling period of stagnation during the Great Financial Crisis, Katayama realized that his true calling was in value investing. He rummages through regulatory filings, crunching gross profit margin and EPS figures, in search of companies poised to deliver outsized growth over a time horizon of at least 2 to 3 years. Good businesses don't come by very often, so when he sees an opportunity, he isn't shy in seizing it, outlaying a significant percentage of his net worth. Or in at least one case, which catapulted him to the status of centimillionaire, he was willing to bet 100% of his liquid assets, and then some more on margin. The name of the company is Japan Lifeline, a nondescript importer and manufacturer of medical devices, which saw its stock price skyrocket 25-fold in less than 4 years, from around 154 yen in November 2014 to a high of over 3,700 in March 2018. But before we try to figure out why this particular company warranted such a concentrated position, we should first develop a feel for his overall investment strategy. A good way to describe his style would be value investing with venture capital characteristics. He looks for value wherever it can be found, but not in a bargain bin hunter kind of way. Rather, he specializes in smaller companies showing strong growth potential. Ideally, these would be more obscure businesses with limited to non-existent analyst coverage. The rationale for this being that market efficiency tends to correlate with the number of eyeballs on a stock. That's not to say that Katayama argues that coverage and institutional interest are a net negative. In fact, these are very useful, but primarily only after the stock has already rallied significantly. The company hits it out of the ballpark with a stellar but unexpected earnings performance. Analysts take notice and begin coverage or raise their forecasts, and institutions start getting in on the action. Before you know it, fear of missing out kicks in, and the market is assigning higher and higher multiples to the stock. Some quote-unquote boring, obscure stock might only command a price-to-earnings ratio of 10, but once people start talking about it, then suddenly it's okay to pay a lot more than that. Metrics like sales and gross margins tell a story about a company, and the particular narrative Katayama looks for is one of metamorphosis. Here's how it works. Going from mediocre company to stock market darling is more about the mix, that is, the quality of sales and gross profit margins, less than it is about the sales growth itself. Sure, top-line growth is definitely welcome, but as Katayama points out, in the best-case scenario, a company might be able to double sales over, say, a 10-year period. The real catalyst, however, is when profits grow several-fold during the same period, on account of a sales mix with better margins, and thanks to better cost management. Katayama's playbook, therefore, consists of finding these companies, and then leveraging other market participants' fear of missing out as a force multiplier of sorts. This is exactly what happened with Japan Lifeline. At first glance, the company appeared to be simply spinning its wheels, on average outputting a mere 2 cents in profit for every dollar in revenue. Hardly the next Google or Facebook. To make matters worse, they had lost money in the fiscal year ended March 2014. Something about a couple of overseas medical device manufacturers they had invested in, or whatnot. These manufacturers needed the money for research and development, and also to cover capital expenditure costs associated with the start of manufacturing operations at scale. Japan Lifeline had also obtained the exclusive right to the sale of their products in Japan. This would prove to be a vital piece of information, but you wouldn't know about it unless you actually read through their earnings results and financial disclosures. Which Katayama did. He always does, because reading and absorbing this kind of information is part of his investment process. That's the beauty of this type of analysis. Japan Lifeline provided him with the narrative, and all he had to do was dot the I's and cross the T's, and make sure the company wasn't over-promising or engaging in misdirection. Revenue and gross profit margins had grown by 10.3% and 4.3% respectively between 2010 and 2014. Upper management at Japan Lifeline expected this trend to continue, as the sales mix became weighed towards products developed in-house, and therefore offering higher margins. They were like, look, we're the real deal. We're integrating manufacturing into our operations, and are in the process of commercializing a number of exclusive products, such as an intracardiac defibrillator and an open stent graft. In fact, we are building a factory so that we can offer a steady supply of products like these over the long run. Sure, this year alone we've spent close to $10 million on travel and transportation expenses. But hopefully you'll believe us when we say these are legitimate business expenses, and not a hobby project at shareholders' expense to catalog Japan's rich regional culinary diversity and vibrant nightlife. Now, all Katayama had to do was run a sanity check on this narrative. We don't know exactly what his process looked like, but a good starting point would have been to read up on these products in trade and medical journals. In other words, were these products any good? Did they receive good reviews? Did they have a large enough total addressable market? Things like that. Another strategy would be to talk to Japan Lifeline's investor relations department directly. Who were they supplying these products to? They probably wouldn't give you any actual names, but it would still be worth a try because they might specify the caliber and size of the parties on the other side of the transaction. He could also have looked up the permits and other details for the construction of the new factory. or even gone and paid a visit to the vicinity of the site itself. Investing often conjures images of complicated formulas and algorithms, but the most profitable trades usually require little to no mathematical prowess at all, instead hinging on good old-fashioned gumshoe work. Long story short, sales and profits at Japan Lifeline really started ramping up as more of these products went online and reached critical mass. Sales grew by 5% in 2015, 19% in 2016, and 22% in 2017. Not just that, gross margins continued to improve, and SG&A expenses went from 90% of gross profit to 65%. The share price experienced an exponential rise, going from 85 yen in 2014 to an all-time high of 3,780 in March of 2018. As it turns out, the company had really been working on its products and not wasting shareholder money.